So why is Wall Street planning to spend $7 trillion on it? This isn't just hype. This is a level of spending that dwarfs entire industries. We are witnessing the largest capital expenditure boom in modern history, all aimed at a technology that, for most people, is still just a free chatbot. Something doesn't add up. Many believe we're in for a repeat of the 2000 dot-com crisis. We have investors throwing money into a new promising technological revolution. We have valuations, namely the CAPE ratio, hitting levels not seen since that very bubble. And the companies at the center of it, they aren't really making any money. This is what's really going on.
You might have seen this chart. Some call it incestuous. It demonstrates the bizarre, circular financial relationships we have in the AI space. Let's break it down. At the center, you have Nvidia. They make the chips, the hardware needed to run these AI models. They are the pick-and-shovel seller in this new gold rush, and they have been incredibly profitable, skyrocketing their market cap to a record $5 trillion. Then you have the AI companies, with the king of the hill being OpenAI. They build the models like ChatGPT and Sora, but to do that, they need to buy compute power, a lot of it. This is where the loop gets weird. Nvidia has pledged to invest $100 billion in OpenAI, in return for OpenAI buying its chips. Think about that. Nvidia gives money to its customer so its customer can give that money back to Nvidia. It doesn't stop there. Nvidia invested in CoreWeave, an AI data center. What does CoreWeave do? It sells compute power to OpenAI. AMD, Nvidia's competitor, supplied OpenAI with warrants for its shares in return for OpenAI buying its chips. That announcement alone sent AMD's stock higher, which literally helped pay OpenAI for the arrangement. OpenAI announced a $300 billion deal with Oracle for data center capacity. What will Oracle do with that money? Naturally, turn around and buy chips from Nvidia, who, remember, is invested in OpenAI. You can see the circle. It has drawn serious concerns. This looks exactly like vendor financing, a tactic that became infamous at the end of the dot-com bubble. Companies like Nortel would lend money to their customers to buy their products, artificially inflating their own revenue. It was a house of cards, and when it collapsed hard. This chart makes it seem like the so-called pick-and-shovel seller is just paying gold miners to buy its picks and shovels, effectively propping up the entire space. Now, to be clear, the arrows on this chart aren't dollar-for-dollar arrangements. It's a simplification. But it could mean Nvidia is overstating its profits. If you invest in your customers to give them the cash they need to buy your chips, you are effectively selling your products at a discount without recognizing the hit to your profit margin. The optics aren't great. We are not beating the bubble allegations. And this is where we have to ask the multi-trillion-dollar question, who is going to pay for all this? This circular loop of money can only last as long as investors believe there is a real paying customer at the end of the line. But what if there isn't? This looks exactly like the vendor financing that defined the dot-com bust. But there is one crucial difference that changes everything, and it's not what you think.
To understand the scale of this, you have to understand the numbers, and the numbers are astronomical. Let's start with the leader, OpenAI. Despite being the most successful AI company, it is one of the biggest money furnaces on the planet. The company is targeting revenues of $13 billion and losses of $8.5 billion for 2025. Their own estimates see them burning through $115 billion by 2029. They're even losing money on their highest tier $200 a month subscriptions because people are simply using the service more than expected. Most users, the vast majority, are melting OpenAI's GPUs as free subscribers. Yet this hasn't stopped the aggressive build-out, not even close. OpenAI has committed to around $1.5 trillion in AI deals. That includes Project Stargate, a $500 billion initiative for data centers, a $300 billion deal with Oracle for compute power, deals to buy chips from Nvidia and AMD forecasted to cost $500 billion and $300 billion respectively. Numbers this big lose their meaning. Let's put them in context. OpenAI plans to build an additional 26 gigawatts in data center capacity. A single gigawatt is roughly the output of a nuclear power plant. It's enough to power almost 900,000 homes. OpenAI alone is planning to consume the power of 26 nuclear power plants simply to run its software. And that is just OpenAI's investment. McKinsey estimates that data centers globally will need to spend nearly $7 trillion in capital expenditures by 2030 to meet the demand for AI. To put that into perspective, America's total capital expenditures for 2024 across all industries was around $8.3 trillion. We are seeing a single industry spend a fifth of America's total capital expenditures. Needless to say, it's a lot, especially for companies that are losing billions of dollars annually.
So we have a massive, unsustainable build-out, funded by circular-looking deals, all chasing a customer base that right now isn't paying. This is the conflict. This is the bubble. Bain & Company estimates that AI companies will need $2 trillion in annual revenue by 2030 just to be profitable. As the Wall Street Journal noted, that is more than the 2024 revenue of Microsoft, Meta, Alphabet, Amazon, Apple, and Nvidia combined. It's 5 times larger than the entire software-as-a-service market. There just doesn't seem to be a path to that kind of profitability. Yes, 88% of companies are using AI. ChatGPT broke records for user growth, but only up to 6% of those users are estimated to be paying for it. And the majority of companies using AI, 61% according to McKinsey, currently see no impact on their earnings. This is all assuming they can even build it. The bottlenecks are very real. The first one is electricity. Building out grid infrastructure takes years of planning and development, and that's if you get through the regulatory hurdles. The NRC application review process for a new nuclear plant can take 5 years alone, with construction taking another 5 or more. That timeline might be longer than these companies are able to woo investors. Then there's the hardware itself. Tech firms have been expanding the assumed lifetime of their servers to 4 to 6 years to spread out the accounting costs. But with Nvidia releasing faster, better chips every single year, some argue the real replacement cycle is much shorter. This means these companies are going to run into higher replacement costs than they are disclosing to investors. And when you throw in the sheer concentration of this industry, it gets scary. 36 companies account for 99% of all AI token spending. Just 2 companies buy nearly 40% of all of Nvidia's chips. 10 companies, mostly involved in AI, account for 40% of the S&P 500. The failure of any one of these companies could lead to massive shockwaves, not just in the space, but in the entire market. OpenAI's deal announcements alone have added hundreds of billions of dollars to the market value of companies like Broadcom, Nvidia, and AMD. If we see a pullback in that one company, it will hurt valuations for everyone, especially when you consider how expensive these stocks have become. Investors are pricing these stocks for perfection, leaving zero room for disappointment. If you're getting value from this breakdown and want to stay ahead of these major market shifts, take 1 second to hit that subscribe button. We're digging into these topics every single week, and it's the best way to support the channel. Okay, back to it. So yes, it is easy, very easy, to see the comparison with the dot-com bubble.
The internet did, of course, revolutionize our lives, but it also led to an 80% collapse of the NASDAQ as thousands of shaky dot-com startups that convinced investors they were on the frontier of a new, highly profitable business, went to zero. So that brings us back to the question, are we truly in for a dot-com 2.0? While there are parallels, a new technology, investor enthusiasm, and concerns of overvaluation, there are also a number of key differences that make for a very different setup. This is why it's not the dot-com bubble. First, let's talk valuations. Yes, the CAPE ratio, that commonly cited measure, is fast approaching the highs of 2000. But the CAPE ratio includes smoothing. If you use a more basic trailing PE ratio for the S&P 500, which just looks at earnings over the last 12 months, the current ratio sits at roughly 30 times. Now that is still high, historically speaking, but during the dot-com bubble, we reached a high of 46 times. We are not yet at the same extended level of valuation. But this is the most important point. Compared to the dot-com bubble, there are actually strong financials and earnings to back up many of these valuations. Morgan Stanley highlighted that S&P 500 companies today are generating 3 times the cash flow as a share of their valuations versus what they were generating in 2000. And on a relative basis, there are nearly half as many unprofitable technology companies today compared to 2000, when 36% of tech companies were losing money. Now, this doesn't account for the private companies like OpenAI or Anthropic, which are highly unprofitable. But, and this is the crucial difference I mentioned earlier, these startups have the backing of companies that are highly profitable and are viewed as financial strongholds.
The companies bankrolling this revolution, Microsoft, Amazon, Meta, Google, are not shaky dot-com startups. They are global giants with very little debt and hordes of cash on hand that they've accumulated over the last decade. While there's some evidence leverage is creeping up, currently a lot of this spending has been backed by cash on hand or cash flows from these large companies. This limits the fallout if one of these investments doesn't pan out. Microsoft's investment in OpenAI is a rounding error for them. In 2000, the companies doing the investing were often just as broke as the companies they were investing in. This also helps us redecode that circular chart. This isn't really a defense of these companies, but when it comes to Nvidia, this approach actually makes sense. Companies like Nvidia are making so much money that it can be difficult to find places to park that capital without dragging down performance. So it's logical that Nvidia would invest in the very ecosystem that will ultimately benefit its future demand. If the companies it invests in are able to succeed, Nvidia is effectively incubating a future customer. It's also not where most of their cash is coming from. Over the last 12 months, the company made $77 billion in operating cash flow and paid out $24 billion in investing cash flow. This vendor financing is just a fraction of that. And many of these large-scale deals with OpenAI are performance-based. Nvidia isn't just writing blank checks. There is a perception that OpenAI may be faking it till it makes it, but the companies with skin in the game are building in off-ramps. Finally, bubbles don't just pop on their own. Part of the reason the dot-com bubble deflated was rampant, widespread fraud. Many large companies were discovered to have been cooking their books. While fraud is certainly possible today, reporting standards have improved specifically because of that crisis. We're also in a very different economic environment. Rising interest rates are often cited as the pin that pricked the dot-com bubble, whereas currently, the Federal Reserve seems to be on a downwards trajectory. It's entirely possible we will see OpenAI's profits scale from here. Just as I was finishing this video, it came out that Sam Altman expects the company to reach $20 billion in run rate revenue for 2025 and hundreds of billions by 2030. I don't know if that will play out, but the companies investing in them get more insight than we do. And yes, companies make bad investments. We are not living in the metaverse that Mark Zuckerberg desperately hoped we would be. But assuming all these players are being perfectly irrational is just as dangerous as assuming they are all being perfectly rational.
So, with all that said, is this a bubble? Yes, I do think there's a bubble of some sort. The lofty valuations are real. The risk of a correction is high. The current investment activity is blatantly unsustainable. We are seeing big tech companies lay off employees, a sign that this capital spending is impacting operations. But it's not the bubble you think it is. The risk here is not a market-wide 80% collapse like 2000, wiping out the entire sector. The real risk is a consolidation. The truth is, we just don't have enough demand for 500 AI unicorns. There is a lot of good research showing that technological revolutions have historically been bad investments on average, precisely because they lead to this boom and bust. The attrition experienced by all the companies throwing their names in the hat has a negative impact on market returns, even if the technology goes on to be successfully adopted.
This is the key. The dot-com bubble was right about one thing. The internet was the future. But it bankrupted the pioneers. Remember Netscape? They were the market leader. They defined the early internet. And if you've never heard of Netscape, well, that kind of perfectly illustrates the point. The AI bubble is the same. The technology is real. It will change things. The question is not, is AI the future? The question is, will the companies building it today still be around to see it? We just don't know yet. And at any point, a geopolitical event, a new headline, a new development could change everything. Even if we are in a bubble, timing it is impossible. Alan Greenspan called out the irrational exuberance of the dot-coms in 1996, over 3 years before the bubble finally collapsed. With companies like Meta viewing the risk of underinvesting as higher than the risk of overinvesting, these rallies can last as long as investors are willing to pile money in. Yes, at some point, these companies will have to transition from surviving on investor funds to earning customer revenues. But how long that timeline is remains to be seen. Thanks for watching.
Let me know your thoughts on the AI bubble. Do you think things are overhyped, or are the concerns overblown? Any and all thoughts welcomed in the comments down below. Thanks again for joining me, and as always, be safe out there.